Hey, this is Jussi. I run a small investment firm that specializes in REIT investing, and recently a subscriber of this YouTube channel asked me an interesting question. He asked me, if you had to retire with just 4 REITs, which one would it be? In today's video, I'm going to answer that question, highlighting 4 of the best REITs for conservative, income-oriented investors that are in retirement or approaching retirement. So firstly, before we get to it, let's define what type of REITs you probably would want to target in this type of situation. Remember that we are only going to buy 4 REITs, so you're not going to be able to diversify as well as someone like me who's an active REIT investor and owns over 20 REITs in his portfolio. So for that reason alone, and also because you're in retirement, you really need to rely on this income, you're probably not going to take that much risk. So this is going to weed out a lot of riskier REITs that we've often highlighted on this channel. Smaller REITs like BSR REIT or more heavily leveraged like Clipper REIT are out of the window. So you probably focus on larger REITs that have very strong track records, great investment, great rated balance sheets, and defensive assets. These are probably the most important criteria to go with. And in what follows, I'm going to give you 4 of those. The first that comes to my mind is NNN REIT, ticker symbol NNN. This is our top pick in the net lease peer group today. It's in our opinion quite a bit more attractive even than Realty Income. The REIT has a 35-year track record of steady dividend growth, so an even longer track record than that of Realty Income. It didn't cut its dividend through the dot-com crash, the great financial crisis, or even the pandemic, which was arguably the worst possible crisis for a net lease REIT. And so this makes me very comfortable that it's unlikely to cut it anytime soon, especially as the REIT's portfolio is today bigger and better diversified than ever. It's mostly focusing on service-oriented net lease properties such as quick service restaurants, automotive centers, home improvement stores, convenience stores, very defensive retail categories that typically have a significant service element that makes them resilient to the growth of e-commerce. Its average remaining lease term is about 10 years. It enjoys nearly 2% annual rent escalations. Its tenants are responsible for all property expenses, including even insurance, property tax, maintenance, like traditional triple net leases. And this results in highly consistent and predictable cash flow that's expected to keep growing even through recessions and allow the REIT to maintain its dividend and keep growing it. On top of its current portfolio, the REIT also retains about 30% of cash flow to keep acquiring more properties. It has a strong BBB+ investment grade rating with exceptionally long debt maturities of 12 years. And so between the organic growth in its portfolio from the rent escalations plus its additional acquisitions, we think the REIT should be able to keep growing its dividend by about 4 to 5% per year over time, which will provide inflation protection to you, and combined with its 5.5% dividend should allow you to earn solid near double-digit total returns over time. And so that makes it a very solid pick for someone who is approaching retirement or is in retirement today. I also think that there's a bit of additional upside because the REIT is today trading at a historically low valuation multiple of just around 12 times FFO. This is also at the bottom of the net lease peer group, whereas, as I told you earlier, this is really a blue chip type of REIT. So in my opinion, it deserves to be towards the higher end of the peer group. If it repriced closer to the higher end, that would result in 30% upside. More likely it's going to reprice closer to the average in the middle ground, and that would lead to about 20% upside. In any case, you have a solid dividend yield, steady growth, some upside, and that makes NNN REIT a very compelling opportunity. The second REIT on my list has many similarities with NNN REIT. Its name is WP Carey, ticker symbol WPC. This is also a net lease REIT that up until recently had a long track record of steady dividend growth. It didn't cut its dividend during the great financial crisis, neither during the pandemic. However, recently did cut its dividend after it spun off a significant portion of its properties into a separate REIT. To be more specific, it decided to sell its office net lease properties in order to reduce risks, also to deleverage the balance sheet in today's higher interest rate environment. And in association with that, it then decided to reduce its dividend to bring its payout ratio to a more sustainable level, to also be able to self-fund its future growth. A lot of the investors obviously didn't take kindly to the dividend cut. This pushed many to just sell the REITs, regardless of the rest of the story. But I actually think that this recent transformation has made WP Carey even more attractive for conservative, income-oriented investors. It has now left the REIT with a much stronger portfolio that's mostly focused on industrial net lease properties that benefit from the growing trends of e-commerce as well as onshoring. What's unique about the leases of WP Carey also is that they enjoy CPI-based rent escalation, so if inflation accelerates, it's better protected than its other net lease peers like NNN REIT. This resulted in much faster rent growth following the pandemic. So very strong, attractive portfolio. It also now has a much stronger balance sheet with a triple B investment grade rating, and its payout ratio now is historically low at about 70%. Again, as I mentioned earlier, this REIT, and up until this recent spin-off, it had a very strong dividend track record. It didn't cut it during the Great Financial Crisis or the pandemic. It only cut it because it lost a significant portion of its cash flow when it spun off those single-tenant net lease office properties. I think this was a good move because this is a property sector that's going to face significant long-term headwinds. Sure, it resulted in a dividend cut and a lot of investors don't like it, but that's now in the past. And if you can look historically over the long run, the REIT has had a really good dividend track record, and therefore I expect it to now resume this historic dividend growth, and you can just ignore this little hiccup that it had along the way. Beyond that, the REIT has massively outperformed the average returns of the stock market, including the S&P 500 over the long run, and combining its 5.5% dividend yield, 4 to 6% annual growth, investors can expect to earn about double-digit total returns. And in addition to that, I think that the REIT has about 20 to 30% upside, because just like an REIT, it's today trading at the bottom end of the valuation of its net lease peer group. I think it deserves to be towards the average or the higher end even, because it owns mostly industrial net lease properties and it has superior leases to most of its peers. So again, here we have a high quality investment grade rated REIT with an above average yield, steady growth and upside potential, which makes it very attractive for our retirement portfolio. Hey, before I go into the third REIT, can you please do me a huge favor and click the like button? That will help me a lot to keep on growing. Thanks so much in advance. The third REIT on my list would be Alexandria Real Estate, ticker symbol ARE. This is the highest yielding REIT on this list. It's today offering a 7.5% dividend yield. Typically, when a REIT is offering such a high yield, it's a bit of a red flag that the market is concerned that dividend cut might be coming, but I don't think that is the case here. Alexandria has a very low payout ratio of just 55%. It has a very strong triple B plus investment grade rating with very long average debt maturities at 13 years, a low LTV of 35%, so it's not heavily impacted by the surge in interest rates, and its dividend has been steadily growing in recent years, and the most recent earnings call, the management even called its dividend rock solid. The reason why its stock is so cheap and its dividend yield is so high is because the market is worried about the oversupply in the life science property sector. This is a valid concern as vacancy rates are historically high, rents are dropping in many markets, and the landlords are having a hard time to release vacant space. However, I think that the fears are a bit overblown here. I don't think that Alexandria is going to be nearly as negatively impacted as the market appears to think, and that's in large part because, first of all, it owns Class A properties in high barrier to entry markets. These are not really competing with a lot of the vacant supply that's difficult to lease. A lot of those are recent office to lab conversion projects that a lot of industry insiders call these zombie properties because they think they will be impossible to ever lease. In many cases, they don't really fit the needs of these life science companies. Secondly, it enjoys 8 years left on its leases on average, which provides a lot of safety in today's oversupplied market. Thirdly, it's very expensive and impractical to move a lab from one property to another, which makes renewals more likely in this specific property sector when compared to others. So ultimately, I don't think that Alexandria is going to suffer as much as the market appears to think. It's going to face headwinds from this oversupply. It's not going to be able to grow its cash flow for a few years. Its cash flow is likely to stagnate or even slightly decline. But when your payout ratio is that low at about 55% and you have a very strong balance sheet with a triple B plus credit rating and long debt maturities, you can take it, and I think that the dividend cut is very unlikely at this time. Beyond that, Alexandria has a fantastic long-term track record. Over the long run, it has even outperformed Warren Buffett's Berkshire Hathaway, the S&P 500, big companies like Walmart. It's been one of the most successful REITs of all time, so I think that the company is under good hands. The fourth REIT that I would include in my retirement portfolio is Big Yellow Group, ticker symbol BYG. This is one of the leading self-storage REITs in Europe, and I think that this is a great opportunity because today there's still about 10 times less storage space per capita in Europe when compared to the US, but the concept is now rapidly growing in popularity. The same demand drivers exist in Europe, things like divorce, relocations, death, unfortunately. I mean, these are all things that lead to storage demand. People in Europe live even in smaller homes. Increasingly, many now want to make space for a home office, so they need storage space, and now it's growing in popularity. Word of mouth is doing its work, and so there is growing demand, and Big Yellow is here to develop new properties, earning high spreads of its cost of capital. And historically, this has allowed it to grow its cash flow and its dividend by about 12% per year. Because of that, it has also historically typically traded very low yields, very high valuations, but today is an exception. During the post-COVID normalization, self-storage was a bit oversupplied, and for a while rent growth was slightly negative or flat, and because of that its market sentiment took a hit. Essentially what happened is that in 21, 22, following the pandemic, rents grew very significantly, and essentially the growth from 23 and 24 was pulled forward to 21, 22. It enjoyed explosive growth, and then its growth was flat in 23, 24, and this has depressed its market sentiment. But now in 25, its growth is already accelerating. I expect it to accelerate further in 2026 as new development projects are delivered and are in their lease-up phase. And yet, despite that, today the REIT is offering a near 5% dividend yield, which is very compelling coming from such a high-quality REIT with such a strong track record. It has also massively outperformed the market over the long run. It has a low LTV of just about 20%, which means that it has significant capacity now to take on new debt, to invest in new projects, to further grow its cash flow and value. And I expect about 20 to 30% upside, just like in the case of NNN REIT and WP Carry. So if I had to retire today, these will be 4 REITs that I would certainly include in my portfolio, but there will be many others. And if you want to access our full portfolio, you can join us at High Yield Landlord for a 2-week free trial. It will be the first link in the description of this video. It will give you immediate access to our core portfolio, which is targeting maximum total returns, our retirement portfolio, which aims to maximize safe income with lower volatility, and our international portfolio, which is investing in Europe, Canada, Asia, Australia, Latin America, and even Africa. There is even REITs in Africa these days. You won't be charged anything in the first 14 days. This is a real risk-free free trial. You can cancel anytime, no questions asked. You will only be charged if you stay beyond the 14 days. So feel free to just take advantage of this offer. Join us to see the portfolio, see our best research. If it's not for you, you can just cancel and follow our free REIT research on our YouTube channel. Once more, if you could please click the like button, subscribe to your channel, we greatly appreciate it as that helps me to keep on growing. Thank you, see you at my next one. Bye bye.